see the sun, I'm rising up, I feel the love now, oh, it's in my vision. Didn't know I ran around, and I got lost, but now I found you. Well, I can't shake this feeling. Oh, it's gonna take me a little while just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now, oh, it's in my vision. And it's telling me run, 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 and don't give up. And it's telling me run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the Daily Stock Analysis. Thank you for joining me today. We have a lot of really good information to give to you today. First off, hey, let's take just a moment, if I could, and just remind you, if you are interested in Regeneron, and you may be, since the president took their new drug, which is called REGN-COV2. He took the drug today at Walter Reed Hospital, I believe it was, and we wish him well in recovering from the coronavirus, him and the First Lady too. But it's interesting because since that news came out, Regeneron, which I just covered on Wednesday in the Daily Stock Analysis, is up about 3% when the entire market is down considerably. Actually, the NASDAQ 100 is off about 2.2%. Most of that was given up by tech stocks. We still have this back and forth between Congress and between the administration, between both houses of Congress over what should be there for the stimulus. And the Speaker of the House, Nancy Pelosi, said that, told the airlines, hold off in laying people off. We might work something out. Because I think she recognizes that the more people that are laid off, the worse that it's going to be for the entire economy. I am really excited for you today because I have some really good information to share with you about two companies. One of them is XM Radio. I'm a big fan of XM Radio. I've had XM Radio for years, but there's a story behind it that you might not know about. And you probably want to know a little bit more about this stock if you're thinking of owning it. Now, remember, the idea that we use today is, and every day, is accumulating stocks for the long term. We're not talking about day trading. But you know what? When we talk about XM Radio, we're going to talk about a company that really has been beat up by day traders called Urban One. And we'll talk about that just a little bit in a moment. We are also going to discuss Seattle Genetics. Seattle Genetics is a quite unique company, if there is a degree of uniqueness, as one of my good friends tells me there is no difference in uniqueness. But anyhow, I digress. So let's get back into it and talk about XM Radio. So here we go. Let me make the screen just a little bit bigger for you so that we can get into it and talk about this really good company. If you may be familiar with some of XM, but just watch a little bit of this. I think that you'll be surprised of a few things. SiriusXM Radio, $242 billion. Did you know that this company just a few years back was this close to bankruptcy? And they got a big infusion of cash from Liberty Media, which brought them back. XM Radio is also the owner of Pandora. And I know there's a lot of you out there that are Pandora fans, as well as Spotify fans and Apple fans and Amazon from that standpoint. So let's go and buy this a little bit. Today, they closed down somewhat. But, if you look at this over the past year, XM Radio has had a tough time with a lot of other stocks after the coronavirus crash, where you see the dancing cursor going here. They started out the year, let's say a year ago, 12 months ago, in October, on October 2nd, they were at $6.17 per share, about $6.18. And they ended today at $5.56. And if you do the math, that comes out to about a negative 10%. So you might be thinking, I'm glad I didn't own that stock. But there's some advantages to this stock going forward. Obviously, the past performance is no guarantee of a future result. But if it's down, isn't the idea to buy low and sell high? Let's look actually back 5 years and kind of get an idea of the way that this stock performed in the past 5 years. 5 years ago, it was at $3.70 a share. Today, as I mentioned, is at $5.56. So really, that's a 49, close to 50% growth. That's an APR, annual percentage rate growth of 8.43%. If most investors out there had an 8% rate of return, they would be very, very happy. But remember, as we talk about some of these stocks, especially the tech stocks, this is not going to continue on forever, friends. We're not going to see this never-ending stock return that we're seeing in tech stocks right now. Although there are some that are doing extremely well. I think that it's really interesting to look at this also in this particular stock. Okay, what are you looking at here? It looks like a stock that took a dive off of a cliff. If you go back 10 years, actually to the year 2000, you can see that the price of XM Radio was $48.15. It was a high flying stock, where today, technically speaking, it's close to penny stock range, although it's not a penny stock by far from that standpoint. And in past years, it's been pretty balanced out, but there's some advantages to XM Radio. Don't look at it though and think, they had a bad year. They've come back from 48%. I wouldn't own this stock, but there's a little bit more to it than that. Let's go past this. If we look at earnings has not been stellar, but it's also not been completely in the tank either. There's a lot going on at XM Radio from that standpoint. Most recently, as of September 27th, they have a new CEO, Jim Myers, to be replaced as CEO. So they have a new CEO. They're going to be heading forward and looking at, new opportunities. Actually, Jim Meyer is to replace David Freer. So one interesting thing, though, when we look at XM Radio, yes, it is around the $5 range stock. They actually pay a dividend of about 1%, and it comes out to be about a penny a share. Now, you might not say that that's a whole lot, but I think that psychologically what's going on here with XM Radio is they're trying to instill confidence in their investors. So they're trying to do something, and paying a dividend is part of it. This is a really interesting graph, because what we try to do here is we try to look at the competitors of the stocks that we talk about too. SiriusXM Radio is going to be the one that's in blue, and it's really kind of hard to tell. The one that is predominant, as you can see the dancing cursor here, is this gold line. What the heck is that? This was a stock that it's a company that's called Urban One. Urban One, you may or may not heard of. It is a radio that's a urban radio. It is a radio that's designed primarily for, the audience is Black Americans, urban Americans. And when the Black Lives Matter things were really heating up around in June, this stock was taken advantage of. I think that's probably the best way that I could put it. And the day traders just went and beat this stock up. You have to look at the size of the company though. When you have companies that are not really big companies, and when I say not really big, Sirius Radio is $24.2 billion. That's what we talked about at the very beginning. Spotify is about twice that size. Liberty Media is $7.92 billion. Urban One is $222.67 million. That's a lot less value than a company like Sirius Radio. But when we look at it as far as like its stock goes, What happened to it? It was basically one of those that the Robinhood investors took advantage of, and they created a bubble. This is actually what ended up happening. The company has a capitalization, that means their value is small enough that it could move a lot by quite a few investors going in and going out and trying to do day trading. And that's actually what ended up happening. Day traders drove this up about 4,000% in a few days. Just remember, this is the way a stock works. Electronically, somebody offers a price, somebody offers another price, somebody offers another price. And if it just keeps going up and up and up and up, there is no limit to it. There's also no limit on the downside. If you remember just a minute ago when I showed you the graph had this big steep decline. And that steep decline was caused by the day traders that were trying to, reap the rewards out of this thing and just basically tear it apart. The bubble burst and the day traders went on to something else. If you were a regular investor in this company, if you bought at the wrong time, you got taken advantage of. Hopefully you didn't buy on top of the bubble. Okay, when we talk more specifically about the possibilities that may be there for XM radio, we talk about the moat of a company. This is what a moat is. Remember, the moat is that imaginary barrier that is between the company and their competition. And let's actually take a look and see what is making XM radio competitive. Well, for one thing, they have 30 million subscribers. That's a pretty good base to start going with. They are also in every single car manufacturer, the major car manufacturers, and about 40% of those cars that have XM radio, where what happens is, this is the way it works. All right, let me make this just a little bit bigger so that you and I can see each other. At least you can see me as I talk about this. What happens is when a car manufacturer sells a car at the car dealership, a brand new car, they have an XM radio, and actually XM and the car manufacturers have a deal where the car manufacturers are actually making a little bit of money off of this deal, where they are putting the radios, the XM radios, in the cars. And then they give you, let's say, a couple of months of free subscription. And then you as the owner, you're left to pick that up if you want to continue it. And what ends up happening is about 40% of the people that buy new cars that has that XM radio in it actually ends up keeping it. And they end up keeping it generally for about 5 years. And the other thing that makes it a big benefit too is that anymore, it's not just for your car. You can also get your XM radio on your mobile device, on your smartphone. You can also get it on your computer and other different types of devices as well. Okay, let's look at a couple of the other advantages that are out there from this company in itself. Okay, moving on. The other thing is this company owns Pandora, and Pandora, yes, is a competitor with Spotify and with Apple, but there's actually a big advantage that XM radio has going for it. You see, one of the biggest expenses that these companies like Pandora and Spotify and Apple have is the ongoing fees that they have to end up paying to the musicians for their music, for their material, which is rightly so. I think that's great. But what you find is with Spotify and with Apple is that they pay by the amount of time that's listened. So if you get a subscription service through Apple or Spotify, the more that you listen, the more that Apple or Spotify actually ends up having to pay to the artist in itself. Now, that's different as it associates with the copyright holders with XM radio. The agreement with XM is that it's a fixed cost, and that's a big, big advantage when it comes to making money. What you end up seeing is that XM Radio has about a 60% gross profit margin. And when you look at it, compare it to Apple or to Spotify, Spotify only has about a 26% margin. And really, a lot of these companies, like the streaming services for music, aren't really making money. They're losing money, quite frankly. But with this higher margin, we're seeing that as a significant benefit to XM Radio, which is really good. That's what the moat is all about. The moat is that barrier that I talked about from the standpoint that's between the company and their competition. Another big advantage is that with XM Radio, it is a real satellite radio. When this company actually started back in the 90s, it was a really big deal. That's why it started off as a high-flying stock, because the talk about having a radio signal or music program or whatever the program is going to be that could actually be bouncing off of satellites in the upper atmosphere was really a big deal. It's not as much anymore because of what's going on. But if you live in an urban or a city area, it's not as much a big deal because cell phone communication is actually pretty good. But when you go to rural America, you're going to find that satellite radio is more significant. Truck drivers also utilize satellite radio a great deal because, when they're driving in the middle of nowhere, the only thing that they can get is going to be satellite radio. They're lucky if they can get, something through a cell service from that standpoint. So, okay, let's keep going on. That's actually the benefits that we're seeing right now to this company. Let's look at what Morningstar is saying about XM Radio. They're saying that the current fair value of it is actually at $5.70. Now, remember the way that the fair value and the current value goes is the fair value is based on earnings per share. So if you have earnings per share and a multiple, which is selected by the analyst, what they do is they select the multiple and they say, okay, maybe 10 or 15 times the earnings per share. And it's a little bit more complicated than earnings per share. But they're saying right now that the actual value based on earnings per share is $5.70, where the current market value is actually $5.56. So what that tells us is that this is actually selling for a little bit under what the actual value should be. It's about a 2.46% discount. I'll get it out there in just a minute. So that really rates it. Morningstar gives it 3 stars. Remember that the star rating service is not like Michelin stars where you go to a restaurant because you're going to get really good food. The way that the star system works is it's based on the fair market value. So if you have a fair market value close to it, you're going to get about 3 stars. I call those GARP stocks. They're growth at a reasonable price. If you're overvalued, then you're only going to get maybe 1 star. If you're undervalued, you might get 4 stars or 5 stars even. There's not a lot of 5 stars in the NASDAQ 100. All right, so let's keep moving on from this standpoint. Let's take a look. Let me make this just a little bit bigger for you. Well, I think you can see it. Maybe not. All right, hold on just a moment. All right. So as we look at this right now, we can see what other analysts are saying about SiriusXM Radio. About 13 analysts, 11 of them are saying that it's a strong buy. One of them is saying that it's a hold. And actually, there's some hold out there that's saying sell it, get rid of it. But on average, this is what the average analyst is saying. Yeah, what the average analyst is saying is that XM Radio is actually a strong buy. I like XM Radio basically because I own it, and I've owned it for years and years and years. I think it's a great service. I thought it was been wonderful traveling, and I like actually getting it on my mobile device too. So, not saying that I'm telling you to go out there and buy or sell it, but I'm just reporting to you what the analysts say. Okay, let's move on to the next stock, which is a truly unique company. Now, if you're my friend out there, Brett, who says there are no degrees of uniqueness, I disagree with you. I think that Seattle Genetics sets the bar when it comes to unique. And the reason is, well, rather than me just spouting it off, let me show you this short little video that I prepared that might give you a little bit of an idea of what they actually do. Seattle Genetics, $33.6 billion in market capitalization. Let's take a look and see what's happened with this stock in the past year. It's actually been really an awesome year for Seattle Genetics, and I think it's only going to get better because they picked up a great big investment from Merck, and we'll talk about that in just a minute. But a year ago in October, it was at $84.54. It ended today at $193.08. That says 10-1. It should actually say 10-2. Every once in a while, I miss a number. But in general, you know, if you look at the spaghetti graph in the middle here, this is where the coronavirus hit. It really didn't affect this company very much at all. It's kept on going on. The year, 1 year, 128.39%. And I think that there's a lot more room to go with this particular stock. I have to remind you that the past performance is no guarantee of future results. And they don't pay a dividend, although you will find that a lot of the drug companies, the larger ones, Pfizer, et cetera, they do pay dividends, but this company doesn't. Okay, let's look at earnings. Earnings have been kind of all over the map from that standpoint. Maybe that's going to change now that they've got a partnership with Merck that could, you know, bring about $4 billion into the company. But, you know, if you look at the solid line, I'm not going to make it any bigger for you because I think you can see it pretty well. It's been back and forth from that standpoint. I think that if Merck was not involved in this company, I would not say that it has as much potential as perhaps it does. But I think that what Merck has recognized is that over the past year, they've had some significant developments in cancer research. I wish them luck and all the prayers in the world, because anybody that has a family member or yourself that's faced cancer, if you can have a cancer drug that attacks just the cancer and it doesn't destroy your body, that's a significant advancement. And that is actually what the development is. You know, that's my layman's explanation of it, that what they're doing is they're developing drugs that can target the cancer. And hopefully not destroy a lot more of the body that goes along with it. And that's one of the biggest things that goes along with this company. If we look at the past year, I want to show you how it competes, because remember, when we're talking about companies in themselves, there are three things that we look for in a stock. We talk to you about the earnings of the company, and we just talked about earnings in itself. And remember, if it wasn't for the potential for the development of the cancer drugs that they have, this company, their earnings history is kind of sketchy from that standpoint. But we always look at earnings. Then we also want to look at how the company competes. And in a moment, we're going to look at how the company, the moat that it's created between its competitors. But let's get back into looking at how it competes. When we look at Seattle Genetics, we also compare it to Immunogen, Pfizer, and Excellis. And you can see actually Excellis has been, the spaghetti graph, it's been all over the map from that standpoint. Some of these smaller companies, they vacillate a great deal more than the companies like Pfizer and Merck, because Pfizer and Merck are so large and they have so many different drugs that they're developing that if one particular avenue of development doesn't work out, then it doesn't affect the overall company. But if you're at a company like, say, for example, Seattle Genetics, is some reason this therapy that they've developed, if it didn't work, it would really tank quite a bit. So it's hinging on that one particular type of development that they have. And they actually have 20 different drugs or so more that they are developing. How does it compare? It compares pretty well with all the other companies. Pfizer, you can see probably the largest of all these companies in green. It moves the least, as the reason is what I just talked about a few minutes ago. Seattle Genetics has probably had the biggest return in total. If we take a look at it over a 5-year period, it kind of gives you the same story from that standpoint. Excelis has been all over the map because of different developments that have come and gone. The most consistent return comes from Seattle Genetics, and that's the company that we're really talking about today. Okay, let's take a look at the moat. You remember what the moat is? This is the moat if you just tuned in. Okay, the moat in itself is that imaginary barrier that is between the company and between its competitors. Now, the moat, I would say that with a company like Seattle Genetics, that they might not even have a moat if it wasn't for an investor like Merck. And there are a couple of agreements that have just occurred with Merck pretty recently. And if you follow on the screen here, what you're seeing is that Merck basically infused them with $725 million right up front. There's another $1 billion in investment equity. And if they meet certain milestones over a period of time in developing their cancer drugs, they could get an investment as much as $4 billion. And that would really push this company forward. And I think that really sets it apart from a lot of other companies like Immunogen and Excelis that are out there. They have a very unique antibody drug conjugates, and that's the basis of the drug in itself. And the patents that they have actually will last through the year 2030. And as I mentioned before, they have about 20 different drugs that are in development. Let's look at what Morningstar is saying. You know, today I told you it finished at 193.08. The fair market value that Morningstar is putting on this is $138. So it's actually selling at about a 39% premium. That only gives it 2 stars. Remember, the star system is based on valuation in itself, whereas a few minutes ago when we were talking about XM Radio, remember that the value was closer to actually what it was trading at, or the fair market value. With this particular type of drug company, you're going to see that when it's trading at a premium, that it's going to be only 2 stars. Okay, let's take a look. Let me make it just a little bit bigger for you so that you can see how it compares. This is what analysts are saying about Seattle Genetics. 17 of them were polled. 9 of them say that it's a strong buy. 2 of them say it's moderate. Nobody's saying it's a sell. There's a handful of them that are saying that it's a hold. So in general, we get this drug. This company is truly a buy. It's a moderate buy. It's not a heavy buy from that standpoint. Okay, so one thing I wanted to remind you about as we talk about the different stocks that we talk about, I'm not trying to encourage you to go out and to jump into Seattle Genetics or to jump into XM Radio. I'm encouraging you to put together a portfolio of stocks. Now, how do you do that? You need to look at what you're saving for. Try to find stocks that do the 3 things that I talked about. Number 1, they have to have good earnings. Number 2, they have to be able to compete with other companies. Number 3, they have to have some sense of stability. And if a company can have those 3 characteristics, then you've picked a good stock. And, you know, in the past month and a half, as we've been going through all the stocks of the NASDAQ 100, there's some stocks out there that really aren't doing that great. And we don't talk about some of the really bad ones because, believe me, there are some bad stocks out there. You want to be careful of those. You also want to be careful of the companies that are being taken advantage of by day traders and try to stay away from those because you just can't really figure out what's going to be going on. I feel for a company like Urban One because with Urban One, it's a good company. It's got a good direction going, but the day traders kind of really made things a little bit crazy, I'm sure, for the company in itself. They brought some popularity to it when it perhaps wasn't as well known, which is a great thing. So back to what I was talking about. If you need help in developing a retirement plan, if you need help in talking about which type of investments to utilize, give me a call. Go over to my website at richfinancialplanning.com. If you go down to the bottom of the page, let me show you what that looks like real quick. If you go down to the bottom of the page, which looks like this, you'll see the button which says schedule a call to learn more. Right when you click on that, it's going to bring you to a calendar, and then you can find a time to set up where you and I can have a telephone conversation and talk about your particular questions, anything that you want. There's no charge for that. And as long as I have the time at this point, I'll be glad to be able to spend a little bit of time with you. And if I can help you further past that, then I'll just leave that up to you from that standpoint. So just keep that in mind too, because what you want to look at when you are thinking about putting aside money in stocks for retirement, there's only 3 different reasons why that anybody wants to save money in stocks for retirement. Number 1 is going to be diversification. Diversification is a good thing, as we've seen today, not only in stocks, not only in the type of stocks, but in the type of investments that you hold. You might not want to have all bonds. You might not want to have all stocks. You might want to have some annuities. You might have life insurance. You want to count as an asset your Social Security, because that's important. If you're not eligible for Social Security, say, for example, if you're in a teacher's retirement system or something like that, your regular income that you would receive as your pension, that's going to be part of your assets. That's not going to be all that you're going to have for retirement, because if you think about it, if people who are going to utilize Social Security, that's only going to give you about a quarter of what you have for retirement. The rest of it's going to need to come from your company retirement plans, if your company has one, or it's going to have to come straight out of your pocket, or you're going to have to continue to work. If you need a guide to help talk through those things, give me a call. The other 2 areas that stocks can be utilized for retirement is going to be growth. And if you go over and you look at my YouTube channel, find a video that's about bucketing, because bucketing will teach you how to use the growth of stocks to set them aside for the future. I won't tell you all about that now. I ask you to go over there and read that. Actually, I wrote a blog about that too. Go to my website. If you go all the way down at the bottom of the page and hit on blog, then you can read the blog that I wrote about the bucketing system too. And then the third is going to be dividends. You can put together a portfolio of stocks that will actually pay you on a quarterly basis, and that can be significant. If you look at the NASDAQ 100, which is an index that I favor a great deal, those 100 large stocks, the largest stocks in the NASDAQ, about 60 of them actually pay dividends. Now, XM Radio is one of those, but it's less than a 1%. But when we average it out, averaging dividends is a really good thing, because not all dividends are going to continue. Obviously, they're stocks. There's no guarantee. But when we look at the long term from the standpoint of accumulating money through dividends, that's a significant part of your growth, and it's a significant part of your income as well. Okay, so as we come to the very end of today, I want to thank everybody out there. Hey, if you're just joining in, let me know where you're listening from. I have some fans in Italy and a few fans that are in India. I'm always glad to hear how your thoughts are about what I talk about. And with that, I guess we'll have to say have a great weekend. And let's wish the best to President Trump and to the First Lady, and also to his communications director, Hope Hicks. Hope that she gets better, and anybody that has the coronavirus. Let's pray that you all do well. So with all that, stay tuned for the disclosure, and I will talk to you next Monday. Have a great weekend.